Hey guys, Dave Keller here with Market Misbehavior. Today we're going to talk about the difference between leading indicators and lagging indicators in the Technical Analysis Toolkit. So a lot of times I find that people sort of group all technical indicators in one big bucket, right? They're all just different ways of analyzing price and, regardless of what sort of input they use, they're all kind of the same. I would argue very much not the case. There are different main types of technical indicators, and I loosely like to group them into leading indicators and lagging indicators. Now, I am generalizing in a pretty big time way today, but let's keep it simple just to start off. Leading indicators basically anticipate some sort of movement. They tell you, I think of them as sort of a red flag indicator. We're nearing a situation similar to previous market tops or market bottoms or previous inflection points, right? We're starting to show conditions similar to previous times when something important happens. So it's not telling you that something has happened, and it's not telling you that something definitely is going to happen, but it tells you we're starting to show some signs similar to previous inflection points. And so I think of those as leading indicators. There's no guarantee that they're going to work at any particular time, but they're good to identify stocks or ETFs with a particular setup, and then you put those on a watch list and start to see which ones actually turn the way you'd expect. The other main category are lagging indicators. These are designed to lag behind the movement. So they're not anticipating that something is going to happen. They're confirming that something does happen. Now, before you say, why is that helpful to just confirm something you already know? It helps a great deal because whipsaws are a really painful part of trading and investing and financial analysis, which is when you get a signal, you act on it, and then the market immediately reverts and goes the way that you would that you are not betting on. And those whipsaws can really hurt your returns. They can really eat up your capital and give you unnecessary turnover. So by waiting for confirmation, we can minimize turnover and make sure we're only taking action on the signals that really deserve our attention. Today's video, I'm going to show you an example of a leading indicator, RSI, an example of a lagging indicator called the PPO. I'll show you how they relate on the current chart of the S&P 500, what sort of signals we've gotten from these indicators going back over the last year or two. Before we get there, by the way, if you like this sort of thinking about technical analysis, market history, and investor psychology, why not subscribe to my channel? Also, give the video a like if you appreciate it. We would super appreciate that back. Put a comment below. Next 10% move in the S&P, do you think higher or lower, and why? Let me know in the comments. Now here we're looking at my daily chart of the S&P 500. On my channel, I like to show really clean charts. I'm making a big time exception today because I just want to show you down and dirty. This is the chart I'm actually using to analyze the S&P every day. This is a chart that's part of my Mindful Investor live chart list. On StockCharts, it's a list of about 25 charts that I keep updated at all times on the StockCharts platform. And so this is literally one of the first charts I look at every morning. It's part of what I call my morning coffee routine. So literally I have a coffee, get ready, put the clothes on, sit in front of the laptop, fire it up. And this is the first chart I look at is a weekly S&P chart, and this is chart number 2, a daily chart of the S&P 500. So what am I looking at when I'm looking at this chart right now? Well, of course, we're recording this in mid-June. We've just had a pretty significant break where the S&P is powering above 4,300. We've talked about this level for quite some time because it's the August 2022 high. It also represents a 61.8% retracement from the January 2022 high to the October 2022 low. Now, if what I just described with the Fibonacci framework doesn't make sense, I'll put a link in the comments below. I just did a video at the end of last week particularly talking about that Fibonacci relationship in the context of a what we call a probabilistic analysis, where you choose which of the 4 paths you think is most likely on the S&P. I think 4,300 is a pretty important level to think about as you're making that sort of assessment. So click the link below if you don't understand what I just said, and that'll help you understand the Fibonacci levels that we're paying attention to. So the S&P has now met resistance and broken through resistance. So now what? Well, we have different indicators in the technical analysis toolkit. As I mentioned, leading indicators and lagging indicators. Now, the example of the leading indicator we're going to use is RSI, or the Relative Strength Index. This is an indicator that was designed by Wells Wilder in the 1970s. He wrote a book called New Concepts in Technical Trading Systems. It's a really interesting book. I'll put a link again in the description below. It's a fascinating book, and literally he writes out on an accounting ledger, how he hand calculated indicators like DMI, the ADX line, parabolic systems or parabolic studies, and this indicator, the RSI. It's one of the most commonly used measures of price momentum in the financial industry, and it's one that I've used for quite some time. And I've enjoyed being able to meet and talk with people like Connie Brown and others who have done a lot of work on this indicator and really thinking about really moving the toolkit forward. Andy Cardwell is another one who unfortunately is not with us anymore, but did a lot to popularize the use of the RSI indicator. So we cover RSI in some of our other videos, but quite simply, it's a measure of price momentum. If you know statistics, it's kind of like taking a z-score of the price action. Instead of looking at the peaks and valleys and the overall trends, you sort of standardize that as an oscillator. It is bound from 0 to 100. So an RSI level of 50 means it's basically equal momentum on bullish and bearish days. An RSI above 70 means it's overbought, meaning it's moved too high too quickly. Most often, you would look for a brief pullback. When it's oversold, when the RSI goes below 30, you think of it as going too low too quickly, and you most likely have a bit of a mean reversion to the upside. And you'll notice that if you look at when the RSI is above 70, kind of the shaded area there, or below 30, the shaded area here, you can see usually you'll get a brief movement in the other direction. Now, important point here, it's usually important not to look at when it becomes overbought or oversold, but when it comes out of that region, because that tells you the condition is now alleviated. So what does it mean right now that the RSI is above 70? Again, this means it's overbought. If you look back at the last 12, 18 months, there are only two other times when we've been overbought. And of course, 2022 was a bearish trend overall, so very rare that we became overbought. But February of 2023, right here, when the S&P tested 4,200, and then back here in August of last year when the S&P tested 4,300. What's interesting in both of those situations, we became overbought. In less than a week, we had pulled back. In the February case, we actually just touched that level, and that was it. In August, we spent a couple days above 70 and then came back down. And in both cases, suggested a bit of a mean reversion to the downside. That's the scenario that we're sort of setting up for if you think about the RSI indicator. So what you would be looking for here, now that we're overbought, as I mentioned, it's a leading indicator. It doesn't tell you we're going to top today. It doesn't tell you today's the top necessarily. What it tells you is we're starting to show conditions similar to previous market tops. Now we want to figure out at what point do we confirm that the price is rotating lower. So a leading indicator like RSI, I often scan for stocks with an RSI above 70, stocks or ETFs with an RSI below 30. And what that tells you are just things that have had a significant move. Put those on a watch list and then look to see when they change, right? When that signal is alleviated. So these are great names and charts to put on a watch list. So now that we've established we're in an uptrend, what do? Now we can go to more lagging indicators, and MACD or PPO is an example of a lagging indicator. Really, one way to think of it, anything involving moving averages most likely is a lagging indicator, because a moving average is looking at the current price but then smoothing it out with previous price history, and it's sort of trying to take the noise away and look at a more slower measure of trend and trend change. So something based on moving average is a little slower than the actual price movements, and as a result, it's probably a lagging indicator. So the PPO or MACD indicators are very, very similar, but basically what you're looking for, a buy signal is when the indicator goes below zero and then turns higher, and the MACD line or PPO line crosses up through the red signal line. That's a buy signal. When we go very high and then we cross below the signal line like we did here in December or in February, or in April, those are sell signals, basically telling you the trend has been up and now the trend is rotating lower. You also notice the histogram, sort of these green bars in the background. Just look for those to be above zero and then flip back below zero. As long as the MACD or the PPO line is above the zero threshold, that's your same signal, because it's just looking at the difference, the spread between those two lines in the indicator. So look at what happened here in August of last year. We became overbought here the second week in August. End of the third week in August, we had actually started to rotate lower, and that was enough of a pullback off of resistance for the PPO indicator to actually register a sell signal. So look at the leading indicator, basically signaling we were nearing a top. the lagging indicator confirming after the top had actually occurred. Same thing happened here in February, right? We became overbought the first week in February, and again, about a week or two later, we actually crossed down through the signal line, confirming that the top was in. So people use these indicators in different ways, right? And I tend to use it just like this. The leading indicator puts it on my list. The lagging indicator, like the PPO, confirms that the trend is now reversed. Now, how you execute, how you trade around that depends very much on your risk assessment, how aggressive or how conservative you want to be with your trading. Some people put a 50% position or take a 50% position off when they get the leading indicator and then take the rest of the position or take the final trade when the lagging indicator is triggered. It's really up to you and how you want to manage around these positions. So worth noting that on the S&P 500 here on June 13th, above 4,300, the RSI now overbought. The leading indicator now telling you we're in similar conditions to previous tops. The lagging indicator is still bullish, right? It still tells you that the trend is higher. What am I looking for here? The PPO line across down through the red signal line. That would basically confirm other signals that we've had at major tops going back for the last 12 to 18 months. Does this make sense in terms of the difference between leading indicators and lagging indicators? These are just two examples, and hopefully through the course of time on this channel, we'll be able to go through other technical indicators, describe them as leading or lagging, how they relate to some of these indicators that we talked about so far. What questions do you have about RSI or PPO or other technical indicators? Let me know in the comments, and I'll be sure to consider that for a future video topic. For Market Misbehavior, I'm Dave Keller. Be well and stay safe, and I'll talk to you again soon.